Hi everybody, this is the second lecture for the topic of CVP analysis. In this video, I will explain several more important things about CVP analysis. Okay, the first thing that I want to explain is about the break-even analysis. Okay, you have to understand what it means by the term break-even. Break-even is a point where a business revenue equal to the business cost. So let's say you have a business that sells cupcakes. So as a businessman or a businesswoman, you always want to know the break-even point, the point where the revenue that you get from selling cupcakes equal to the cost that you spend for the production of the cupcakes. So let's say you spend for the cupcake 1,000 ringgit. You want to know when is the time you can get break even, the point where the amount of sales or revenue equal to the cost that you have spent. If you are a businessman or businesswoman, when you achieve the break even, you are happy, because it shows that you have covered the cost that you spend for the production. Okay, there are three methods that you can use to calculate the break-even point. The first one is called the graphical analysis. To calculate the break-even point using the graphical analysis, it is not difficult. So the thing that you have to do is you have to draw a graph. And then you have to draw cost line, total cost line. Then you have to draw total revenue line. The intersection between the revenue line and the total cost line is the break-even point. The intersection is the point where total revenue is equal to the total cost. So that point is the break-even point. If you draw the graph on a graph paper or using Excel or other computer software, then you can see the dollar, the break-even point in terms of dollar, and also the break-even point in terms of quantity. It will show that how many dollar of sales you have to achieve to get the break-even, and also it shows how many cupcakes you have to sell to achieve the break-even point. Using the graphical analysis, it is not difficult, but it is a slow process, because you have to draw the graph, and then you have to identify the intersection, and you have to see the quantity and dollar, etc. So it is a slow process, so it is not very practical. So the second method that you can use to calculate the break-even point is called the equation method. Okay, and the third one is the contribution margin method. So we see the how to use equation method to calculate the break-even point. Okay, when you want to calculate, when you want to use the equation method, you have to use this basic formula. Always remember, the break-even point is a point where total revenue equal to total cost. So you focus on the second equation in this slide. Total revenue equal to total cost means the sales or total revenue equal to the total variable cost plus total fixed cost. That is the break-even point. So at that point, the profit is 0. So let's see. Okay, we use the wind bicycle company example. So okay, remember the data here. For the wind bicycle company, the product is the bicycle. So the price of the bicycle is $500 per unit. The variable expenses, the unit variable expenses is 300. It means that the unit variable cost for one bicycle is 300. And here another one that you have to see, you have to remember is for this bicycle company, the fixed cost is equal to 80,000. So these are the data. So let's see how we can use the equation method to calculate the break-even point for this bicycle company. So remember the formula is sales or total revenue equal to variable cost plus fixed cost. Okay, now we want to identify the break-even point in terms of quantity. We want to know how many bicycles have to be sold to achieve break-even point. So the quantity that we want to find is Q. So see the data here where Q equal to the number of the bicycle. Unit selling price is 500. Unit variable cost is 300. Total fixed cost is 80,000. So we use this. So the 500Q equal to 300Q. 500Q is 500 is the price times quantity. That is the total revenue. The total cost is the variable cost plus fixed cost. So the variable cost is 300 times quantity. The fixed cost is fixed, so it is 80,000. So you solve this equation. So you see here the Q is 400 bicycle. It means that for we have found what we want in this calculation. This Q 400 bucks means this is the break-even point. It means that for this bicycle company, the bicycle company will achieve break-even when the company sell 400 bicycle. So that is the break-even in terms of quantity. So you have to know also the break-even in terms of dollar. This is for the business to achieve. The business has to know how many dollar of sales they have to make to achieve the break-even point. Okay, so the way to calculate the break-even point in terms of dollar is very easy actually. So you already know that the company can achieve the break-even if the company sells 400 bikes. So what is the break-even point in terms of dollar? 400 bikes times $500, because every bike or every bicycle is the price is $500. So 400 bicycle times $500, the answer is $80,000. So if the company can sell, or if the company can make $80,000 of sales, then the company will achieve the break-even point. oh, I'm sorry, 400x times $500. So $500 times 400 equal to 200,000. Okay, so it means that if the company will achieve the break-even point when the sales is 200,000. Okay, the second method that you can use to calculate the break-even point is a method called contribution margin method. I also call this method as a formula method. So using this method, you just have to memorize this formula. So if you want to calculate break-even point in unit, the formula is fixed cost divided by unit contribution margin. If you want to calculate break-even point in term of dollar, the formula is fixed cost divided by the CM ratio. Okay, if you use this formula, let's see, we calculate the break-even point for the bicycle company using this formula. So now first we want to calculate the break-even point in terms of unit. We want to know how many units of bicycle has to be sold to achieve the break-even point. So we use this formula. So fixed expense for this bicycle business is 80,000. And then 80,000, and then the unit contribution margin for this bicycle business is 200. Okay, you have to remember how to calculate the unit contribution margin. So 80,000 divided by 200, and then the answer is 400. It means that the business has to sell 400 units of bicycles to achieve the break-even point. So this answer is same like the answer when you use the equation method. Same answer. So okay, let's see now the break-even point in terms of dollar. The break-even point in terms of dollar, the formula is fixed cost divided by CM ratio. So you just put the number. The fixed cost for the bicycle business is 80,000, and then the CM ratio is, okay, you have to remember the way to calculate the CM ratio. The CM ratio in this for this bicycle business is 40%. So 80,000 divided by 40% or 0.4 equal to the number that we have here, equal to 200,000. Okay, so you can choose. You want to use the equation method, you want to use the graphical method or equation method or contribution margin method. The answer is same. These three methods can be used to calculate the break-even point. So if you see a question in the exam or in the test or in the quiz asking you to calculate break-even point, you can use method 1, method 2 or method 3. I cannot recommend the method 1 because difficult to draw a graph, or not practical to draw a graph to find the break-even point. So you can use the equation method or this contribution margin or formula method. Okay, this is a sample question. So you have seen this question. Coffee Clutch is a business. The average selling price of a cup of coffee is $1.49. The average variable expense per cup is 36 cents. Average fixed expense per month is 1,300. And then the question asks you, what is the break-even sales in unit? So the question asks you break-even point in terms of units. So remember, you can use the equation method or the formula method. So let's see what is the answer. So this answer is calculated using the formula method or the contribution margin method. So the formula is fixed cost divided by unit contribution margin. So for this Coffee Clutch, the fixed cost is 1,300. The unit contribution margin is $1.49 minus 36 cents per cup of coffee. So the answer is 1,150 cups. So for this Coffee Clutch business, if the business want to achieve the break-even point, the business has to sell 1,150 cup of coffee. And then the same question, the same scenario. So the question asks here, what is the break-even sales in dollar? So if the question asks you to calculate break-even point in terms of dollar of sales. So here the answer is calculated using the formula method also, because it is easy and straightforward. So the formula is fixed expense or fixed cost divided by the CM ratio. So the fixed cost in this question is 1,300. The CM ratio, you have to remember the calculation for the CM ratio. The CM ratio is the unit, the contribution margin divided by the unit contribution margin divided by the unit price. So the answer is 1,715 cents. So if the business want to achieve the break-even point, the business has to make sales of 1,715 cents. Okay, that is about the calculation of break-even point. Now, the next important thing in this chapter or in this topic is you have to know how to calculate target profit. Okay, target profit means let's say you have a business and then you have a target profit. Let's say you have a cupcake business and then your target is every month you want to achieve $5,000 profit. So using this knowledge, you will know how to calculate the if you will know if your target profit is 5,000, you will know how many cupcakes you have to sell to achieve the $5,000 profit per month or per week or anything. So let's see the way to calculate the target profit. We use the bicycle company still. Suppose the bicycle company wants to know how many bikes must be sold to earn profit of $100,000. Okay, how to calculate how many bicycle has to be sold? So let's see, do it. Okay, you can use two methods to calculate the for this target profit calculation. First, you can use the formula, the equation. So the equation is here. Remember this equation? Revenue equal to total revenue or total sales equal to variable cost plus fixed cost plus the target profit. You put the target profit here. So for the bicycle example, the revenue, the Q is the quantity that you want to know. How many bicycle has to be sold to achieve the $100,000 profit? So one bicycle, the price is 500 times the quantity, that is the total revenue. And then the total variable cost is $300 per unit times the quantity. That is the total variable cost. Plus the fixed cost is 80,000 for this bicycle business. Plus you put here the target profit. The target profit here is 100,000. So you solve this equation. So you will see that the Q is equal to 900 bicycles. So it means that for this company, for this bicycle company, this bicycle company, if the company want to achieve the target of $100,000 profit, the business has to sell 900 unit bicycle. So let's say you have you have a cupcake business. You can calculate if you want $5,000 profit every month. You can calculate how many cupcakes you have to sell. So to do the calculation, you have to know the unit price, unit variable cost, and the unit and the total fixed cost. So you can calculate. You can use the formula also to calculate the target profit for this target profit calculation. So let's see here the same data. Let's say the bicycle company want to achieve profit of $100,000. So how to calculate the target profit number using the formula. So you use the formula to calculate the break-even point in terms of quantity. So to calculate the break-even point in terms of quantity, the formula is fixed cost divided by unit contribution margin. But when you want to calculate the target profit quantity, so you just add target profit, fixed cost plus target profit. So see here, for this bicycle company, the fixed cost is 80,000. The target profit is $100,000 divided by the unit contribution margin for this bicycle business is 200. So you will get the same answer, 900 bikes. This company has to sell 900 bikes per month to achieve the profit of $100,000. So if I ask you in the exam or in the quiz, you have to calculate the quantity to achieve certain target profit, you can use the equation or you can use this formula. Okay, now see the coffee clutch business again. So the data you have seen earlier, the price, the unit variable cost, the fixed cost, and then the question asks you how many cups of coffee have to be sold to achieve target profit of $2,500 per month. So how to answer this question? I think this question will use the formula method because it is easy. See, the formula method is fixed cost plus target profit divided by unit contribution margin. So the fixed cost is 1,300, the target profit is 2,500, and then the unit contribution margin is $1.49 minus 36 cents. So you see here the business has to sell 3,363 cups per month to achieve $2,500 profit. So if the number is 3,363 cups per month, so the company can set a target for daily sales. How many hundred of coffee has to be sold every day. Okay, so and then at the end of the month, the company can achieve the target profit. Okay, this is the next thing in this topic. So you have to know about the margin of safety. The margin of safety, okay, to make it simple, the margin of safety is the difference between the actual sales or actual revenue and the break-even revenue or sales. So if there is a question asks you, to us to calculate margin of safety, then the way to calculate it is you show the total sales or revenue and then minus the break-even sales or revenue. So for this bicycle business, the actual sales in the sample income statement, the actual sales is 200,000, and then the 250,000 the actual sales, and then the sales at the break-even point is 200,000. So the margin of safety in term of dollar is 50,000. In term of unit is 100 unit bikes or bicycle. Or margin of safety also can be expressed in term of percentage. So you calculate the margin of safety 50,000. So you divide the 50,000 by the actual sales of 250,000. So margin of safety also can be said as 20% of sales. Okay, this is the coffee clutch business. The question asks you, what is the margin of safety? So always remember, the calculation is margin of safety equal to actual sales or revenue minus the break-even sales or revenue. So here, so total sales. Okay, this one is in terms of quantity. So the margin of safety is 950 cups or 45%. Okay, I think this is the last one. This is the last thing that is important in this topic. The operating leverage. So the operating leverage is a measure of how sensitive net operating income or net profit is to the percentage changes in sales. With high leverage, a small percentage increase in sales can produce a large percentage increase in net profit. Okay, so the formula to calculate the degree of operating leverage is contribution margin divided by the net operating income. So you have to remember many formula in this topic. So this is the bicycle company. See, the bicycle company. So the operating leverage is contribution margin divided by the net profit or net income. So for this bicycle company, the contribution margin is 100,000 divided by the net profit is 20,000. So the operating leverage for this company is 5. So when you know that the operating leverage is 5, it means that if the bicycle company increases its sales by 10%, the net operating income will increase by 50%. How to know it will increase by 50%? The percentage, see the gray box. Percentage increase in sales is 10%. So if you want to know the percent increase in profit, then 10% increase in sales, you times the operating leverage. You will know that there will be an increase in profit by 50%. So you can verify the number you in this income statement. So this is the actual sales, 20,000 profit. So if there is a 10% increase in sales, so if there is a 10% increase in sales, the sales will increase from 250,000 to 275,000. So we have predicted that if sales increase by 10%, the profit will increase by 50%. Is it true? Is it true the prediction is correct or not? So we see here, we develop a new income statement. So the sales is 275,000 the variable cost is 165,000, the contribution margin is 110,000, the fixed cost is fixed 80,000, so a new profit is 30,000, so it is correct. You can, if you know the operating leverage of a business, you can calculate the increase in the net profit when the increase in sales is given. Okay, let's see this coffee clutch. The question is, the data is same. What is the operating leverage for the coffee clutch? So remember the formula, contribution margin divided by the net profit. So the contribution margin is 2,373. The net profit is 1073. So the degree of operating leverage is 2.21. And then the question, a new question here. If sales increase by 20%, how much should net operating income increases? So how to answer this question? The answer is 20% times the operating leverage. So 20% times the operating leverage, 2.21, the percentage increase in profit will be 44.2%. Okay, this is the end of the chapter. I have to finish this chapter. So you have seen many important things in the topic, in this topic about CVP analysis. This topic is very useful. Your knowledge about the CVP analysis is very useful if you have your own business in the future, or you are working in a business in the future. So you have seen how to calculate the break-even point, how to calculate the target profit, how to make simple decisions using CVP analysis knowledge, how to calculate the margin of safety, and then how to calculate the degree of operating leverage. You have seen these very interesting and important things related to CVP analysis. So you have to aware when you do this all these calculation and important things, you have to follow several assumptions. The first assumption is selling price is constant. Remember, when we did all the calculation, we assume that selling price is always same. When we do all the calculation, we refer to the bicycle company, the selling price is always $500 per unit. We assume that. And then the second thing is we assume that the costs are linear. We assume that the unit variable cost is same. You produce 400 bikes, 300 bikes, 500 bikes, 800 bikes, 900 bikes. We assume that the costs are linear. So for your information, the calculation for the break-even point also can be done if in a company that produces several products. But here in this slide, I just explain how to do the calculation for a business that produces one product only. But if a business produces several products, they can do the CVP analysis with additional formula and equation. And number 4, in this topic, we assume that in manufacturing companies, inventories do not change. Unit produced equal to unit sold. When we do all the calculation, we assume that if you produce 500 bikes, you sell all the bikes. But in real situation, if you have a business, if you produce 500 units product, maybe you cannot sell all. But in this calculation, we assume that if you produce 500 units, you will sell everything. So this is the end of the topic. Thank you very much. Do not forget that you can communicate with me in the comment section.